I think silver is definitely performing even better than gold more recently. I have a feeling that silver is long overdue for a big move. I have a feeling silver is going to start to really outperform gold here moving forward. And I'm of the view that this could be very interesting for silver investors, because it's, in my opinion, it's a matter of time for us to see the prior highs being taken out. And so I think we're getting close to something big here.
Global macro analyst Tavi Costa expresses concern over the extreme valuations of equity markets, predicting a significant decline if a correction occurs. He believes metals will see less downside and predicts a healthy consolidation for gold before its next big move. For example, when the stock market collapsed in 2007, investment demand for gold spiked and continued to rise, and gold doubled in value between 2007 and 2011. Similarly, with fear and uncertainty at an all-time high during the COVID-19 pandemic, the metal price hit record highs. Regarding silver, Tavi expresses a more bullish outlook, predicting that it is long overdue for a major upward move and will likely begin to outperform gold. He believes it's only a matter of time before silver surpasses its previous highs, making it an exciting opportunity for investors. Meanwhile, in the shadows, silver has enjoyed a nice run-up of its own. The white metal is up 29% year-to-date, about the same as gold in percentage terms, and this silver bull may have an even brighter road ahead of it than gold. According to analysts at UBS, silver will likely outperform gold over the next 12 months. Based on recent trends, TaviCosta notes that silver and gold prices, when adjusted for CPI, have followed similar patterns. He expresses confidence in this technical setup, predicting that both metals will break past their previous highs. According to the CPI, since the inception of the Federal Reserve in 1913, the dollar has lost no less than 97% of its purchasing power. On the other hand, gold preserved its value during the same period and, according to the CP1, even gained purchasing power. Adjusted for inflation, the price of an ounce of gold in 1913 is equivalent to 662 present-day dollars, whereas the current price of gold is about $2,500. Now, we present the clips of Tavi Costa's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
My view is that, I've always think on a pendulum perspective. I mean, if things have, really gone very far on the pendulum in terms of valuations in equity markets. So how much can we fall on that front if we see a real reckoning moment? A lot. And how much can we see a fall in metals and other things that are historically undervalued? Probably not a lot. And so from a relative standpoint, I find it attractive to still own those things. Now, do I think gold has got slightly ahead of itself recently? Yeah, I do think so. I think gold had a big move. I mean, most of the even more technical indicators are showing that has been quite the move for the metal. Now, does that mean that we can see a large correction? No, it doesn't mean that. Doesn't mean we're in a bubble or anything like that. But we could see a consolidating period before another big move, and that would be just normal. That would be hopefully very healthy as well, to kind of take away a little bit of this expectation that gold prices will only go up from here. And gold prices can fluctuate too. So I can see that happening here. I know we're seeing a down day today, and I think that could be, we could easily 5-7% declines on the way up, and that's just normal part of the game. Now, silver, I have a different view. I think silver is definitely performing even better than gold more recently. I have a feeling that silver is long overdue for a big move. I have a feeling silver is going to start to really outperform gold here moving forward. And I'm of the view that this could be very interesting for silver investors, because it's, in my opinion, it's a matter of time for us to see the prior highs being taken out. And so I think we're getting close to something big here. If you look at the silver price behavior versus gold, adjusted for CPI. I know people are going to say, why CPI, Tavi? But it is interesting. You just got to say that it's interesting, at least, that they follow each other exactly the same. Like both have not taken out their prior highs, and they both have this massive cup and handle on the chart. I find that interesting because I myself, and I think everybody that follows precious metals tend to say, well, silver is the more volatile version of gold. And it's true. But it is interesting as well that silver is almost like gold adjusted for inflation in a way. So I find it a interesting way as well to sort of think of the metal in that front. But I do think that cup and handle is real, that massive cup and handle, and those. It's one of my favorite technical formations. A lot of people overlook that because it looks so simple and unrealistic, just because it looks so simple. And in Wall Street and investments, we just tend to overcomplicate things. But I think actually cup and handle formations make a ton of sense historically. And even if I don't want to go into this, but even when you think of your own life, your first decline in life, your first decline in the first dip professionally, for instance, or personally, can be a bad one. Your second one will probably not be as bad because you're more prepared and it changes how your behavior would be under the same level of pressure you had before. And so I actually think cup and handles psychologically make a lot of sense. And again, not to get into that too deep, but if so, I think we're going to take the prior highs in silver. I think we're going to take the prior highs in gold adjusted to CPI or inflation. And that could be really interesting. Now, I mean, keep in mind, I'm not saying CPI equals inflation here. I'm just saying that we just haven't seen that measurement. And for investors who actually put money into things in general and deploy capital, CPI does matter.
During the interview, TaviCosta expressed concern that market participants overlook real inflation by focusing on CPI data. He predicts the Federal Reserve is trapped due to rising debt costs, limiting its ability to raise rates. Tavi suggests suppressing rates or increasing spending, which could negatively impact the US dollar. Traders gauging how to play further downside in the US dollar are looking to the relative strength of economies worldwide as interest rate shifts from global central banks shake up currency markets. The US dollar index opens new tab, fell 4.8% against a basket of currencies in the third quarter, its worst quarterly performance in nearly 2 years. Pressure on the US currency increased after the Fed delivered a jumbo-sized 50 basis point cut last month, its first reduction since 2020. Meanwhile, Tavi concludes by expressing his bullish outlook on emerging market currencies, which he believes could perform well in this environment. Let's get back to the interview.
Well, I think there's a notion that inflation is not an issue anymore from market participants in a lot of ways, just because they tend to look at CPI, but that's not the real world. The real world is that people are they're also constrained on their spending because everything has gone up in prices in a very significant way. And those prices have not returned to levels pre-pandemic. In fact, they're going higher. And particularly the things that really matter, food and housing and others. And so if we are living in a world like that, the structural side of this issue is that it tends to cause the consumer to change the way it addresses its financings. And so it changes also how people tend to spend their capital in different things. And so you tend to see savings in different aspects and demanding higher wages. And all these things are critical changes in the whole landscape of the macro setting. And so that I think a lot of people in the macro, now I shouldn't say macro, but in the investment world are sort of missing because they're just so fixated on CPI and PCE and other things, which matter from a policy standpoint. So if you're fully analyzing what the Fed will do, yeah, you should be looking at these things too. But at the end of the day, you have a Federal Reserve that is constrained too. And a Federal Reserve, sorry to use that word so many times, but a Federal Reserve that is trapped, that is not able to raise rates despite having a structural inflationary problem. And that's really because of the cost of the debt is eating into the spending of the government. I had a good chart that I put out in our letter recently that basically shows that about 55% of the fiscal spending today is not pro-growth anymore, right? It's interest payments, it's entitlements, and that's the highest number in 40 years. So you got to stop and think, well, is this starting to creep into growth? What are the possible policy changes to address the fact that majority of our capital is going to non-growth and non-productive spending? And the only way, in my view, is two things: is you suppress rates, one, and that will reduce interest payments. Interest payments is to that 55%, 20% of that is interest payment alone. So, okay, well, that's a significant amount that can be, reduced if we cut rates. That's what the Fed is doing. Or number two is increase spending further, take the deficit even higher. But we already have a twin deficit, which when you add the imports and trade balance, I should say, in the current account, you're already running a 10% of your GDP on a twin deficit right now, which should hurt the dollar. I know a lot of people say, well, the dollar, the cleanest dirty shirt. Yeah, it used to be, and now we're running a twin deficit of double digits. We have interest rates that are way higher than everybody else at this point. So we got to adjust, and I shouldn't say interest rates, I should say interest rate payments relative to GDP. And so those adjustments are likely to have major implications in the US dollar versus other fiat currencies, not only versus hard assets. So I'm actually very bullish and very constructive on emerging market currencies right now. I think that they can do very well on the back of this scenario.
Technological advancements, particularly in the electronics and renewable energy sectors, are helping to increase the demand for gold. As these industries grow, demand for gold in technological applications may rise, adding to upward pressure on its price. How do you see the interplay between ongoing conditions and gold prices affecting your investment strategy in the coming years? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.